Introduction to Personal Financial Planning. Within this section, we're learning about the personal finance planning for your wealth. For your job marketability, we identify the key components of a financial plan and certainly how financial planning affects your cash flow. Now, first to the definition. What is personal finance? At the end, the process of planning your spending, financing, and investing to optimize your financial situations. So at the end, we're talking only about the personal, the private area, and not a corporate area. Spending most of the time is for rent, for example, insurances, financing in form of loans, and investing certainly for stock, bonds, mutual funds. To optimize your financial situation means that you have a certain goal which you want to achieve in the future, and you're trying to optimize spending, financing, and investing for achieving this goal. For that, you need a financial plan. The plan basically specifies your financial goal and describes at the end the spending, financing, and investing to achieve these goals at the end. How an understanding of personal finance can enhance your wealth? Certainly, it's improving your financial skills and decision-making processes in your private area. It helps you to judge the advice of financial advisor, so you don't have to take everything for good what they say. It enhances your job marketability, because if you have some ideas about financials, it always increases your knowledgeable. Entering the personal finance career if you want. Now, what are the components of a financial plan? Of course, budgeting and the tax planning. Then managing your liquidity is very important. Financing your large purchases. Talk about houses, cars. Protecting your assets and income in form of insurances. Investing your money, bonds, stocks, and planning your retirement and the estates. That all belongs to the financial plan. A plan for your budgeting and tax is certainly building up a budget. The budget is nothing else than the process of forecasting future expenses and savings. This can be done in form of a balance sheet. You know that from the corporations. You have on the left side the assets, and on the right side, liability. Asset minus liabilities gives you then the net worth. Known as equity in the corporate area, net worth basically on the private level. When we look, we have the income after taxes, then we have the spending and the savings. And the more you are spending, the less you can save. If you have less spending or you are able to reduce your spending, then certainly there will be the possibility to have higher savings. That could contribute to the achievement of the goals, of course. Now, very important is to manage your liquidity, because liquidity basically gives you the possibility to pay your expenses on the short term whenever it's necessary. For the liquidity, the money management is important and the credit management. The money management basically says how much money to retain in a liquid form, so you are able to match all the short-term payments, or if you have enough, you have a surplus, whether you can invest something short-term. Credit management is the opposite, meaning how much money I can use in form of a credit line or in supporting my spending from the bank side. At the end, also in the private level, I always have to be liquid. Now we know that there is a plan for the financing of your large purchases. In the States, very often, certainly the college tuitions are very important for the kids. Cars, houses, sometimes also furnitures, or refurbishing your house. Here, the loans play a very important role. We will talk about later in the other sections very deeply with the personal loans. We talk about what are the components of loans, fixed rate mortgage loans compared to the variable rate mortgage loans. This is very important for the large purchases. Now, a plan to protect your asset and the income is definitely based for the insurances. You have to have insurances for the income. This is, for example, health insurance or any kind of a life insurance, but you also need insurances in form for the cars or the house owners. You have a liability car insurance, you have a liability home insurance to protect these assets, and so on. Now that has to be included into your financial plan. Then you have your investing plan, the saving plan. That's what you have as a surplus. That's what you can put aside for long-term investing. Sometimes also for short-term, if you have a surplus, but you know you need this in the next 12 months, for example, to buy a car. The primary goal of investing your money is certainly long-term achievement of a high return based on your risk level, and this can be done in stocks, bonds, mutual funds, and real estate and other possible assets. As I mentioned, the risk is very important, so you invest in risk adequate investments for you. Last but not least, we have the plan for your retirement and the investment. Most of the financial plans have the goal for retirement. Well, that means at the end you have enough money when you retire to keep the standard of living in the same way you have before retirement. So for that you need invest, you need your liquidity planned, and you need a surplus at the end. The estate planning is then after dying, what happened with your wealth, with your money, how should it be distributed after you're dying. Now, building up a financial plan is then also to see what the net worth is, how the wealth might be built up, and affect certainly then all components which you have, no matter whether there are cash inflows and cash outflows. If we look on this on a graph, we see here that the first part is certainly always the income, because the income gives you the possibility to build up your wealth. From the income, it comes to the cash, depending on the spending which you have. The spending is that what your daily living is, either for food, for any kind of going out, kino, cinema, and so on. But from the cash, from the surplus, you have to think about what then the retirement is, investment is, and what you need for insurances. But that will be all spending as well, but that belongs then to your planning. The liquidity will be affected by all the deposits and the credits. Deposits is that what your surplus on the income is. The credit is that what you see overdraft of your normal bank account. Financing will be the loan. This increases certainly your cash, but be careful, you also have to pay back interest and amortization of these loans. So at the end, a financial plan needs to include all these areas, in which we will look later on a little bit deeper into it. Now, you have a little bit of an idea about what personal financing is, or what a personal financial planning is, what it is doing for your job marketability. You identify, or you're able to identify, the components of a financial plan, which we will discuss more in depth later on, and how these financial plans may affect your cash flow.